Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook, and I'm going to be your host for about the next 25 minutes here on Options Guide TV. A lot going on. We had ADP come out with some employment numbers on Wednesday, and based off of those numbers, it was kind of indicating that the non-farm payroll numbers were going to be quote unquote good. And by that, I mean they were going to be bad. So the marketplace has reacted because the non-farm payrolls blew away the estimates today. 272,000 versus an estimate of 192,000. I'm doing that from memory. And the markets prior to the open reacted more negative than they are right now. But we have so much going on. We also have GameStop. They came out and announced earnings early because of the big event that is supposed to happen at noon, where the kitty is supposed to talk about his position in GameStop. So, with that said, GameStop has been in the headlines all day long. They've already stopped the stock 3 or 4 times. The market just opened up. Right now, the stock is down about 37 points. And according to the huge position that that the kitty is supposed to have on GameStop, at least from from the screenshot that was shown, the stock. Oh man, it's just such a drama. And so I was going to talk a little bit about GameStop today and the dangers of trading it and what happens to stocks that are so heavily shorted and how hard it is to actually capitalize if you take a directional position on that underlying. So before we get there, though, we had 2 trades that we put together on Wednesday. The first trade is in NVIDIA. And in NVIDIA, we double down. We put on a trade going into their 10-for-1 stock split announcement and did a long call spread. And then we have now added a long call spread for the week. So we did that on Wednesday. And this is the last week to actually trade NVIDIA at the higher priced option contracts. So what we put together, if you look at, let's start by just pulling up a chart in NVIDIA, if I can get there. No, I think we'll stay in the trading side of things. Internet is just a little bit too sketchy today, and I see that I'm frozen right now. All right. Well, I'll just mention the trade in NVIDIA. I am traveling and I'm having a tough time with the internet at this point in time. But if I look at NVIDIA, the stock right now is at 1,188. We had a fairly big run up in the underlying stock as my internet just came back online, and that the stock actually ran up. And now with the news as we head into it, this is also becoming an extremely volatile stock and a tough one to trade. I like the trade that we put on. You could have closed it out yesterday at a profit, but we now see that the market is down 21 going into the end of the day. And the trade that we put on was the 115, 125 with the June 7th expiration. All right. So the market right now is at 1,188. We're right in the middle of that trade. So 115. 1125. and 115. Okay, so we bought this option contract and we bought this one and we sold that one. So here's where our current position is at 115, selling 125. There we go. And it's trading for $9 and $9.83. So you put the position on, had a strong run up yesterday. The stock continues to go up. It blew up above the 125 strike. And now, if we come all the way back, see where the 1200 is at 450. So if you were to just on this position itself, we put it on for $5.50. We can sell it right now for $9.83. And I would close it and get out of the position. I wouldn't want to go into the expiration, mainly because then you're forced to buy and sell the stock, and it just makes it a little bit messy. Willing to give up to 20 cents in order to just close out the NVIDIA position. We also went in and looked at a skip strike butterfly in the NASDAQ, which is NDX, and we had a position that had been hurting us quite a bit in that we put on that trade hoping that the marketplace would stay neutral to bearish with a little bit of a bullish upside. So we started that trade on Friday, and it blew through the numbers there. And now it's came all the way back down. We put one together on Wednesday, and the Wednesday trade with the Friday expiration was we bought the 19,200 strike call. So let's clear this. And this is where we're at on that trade. So the market was good to us in this scenario with the June 7th expiration, with the very near term expiration. And we bought the 1900 strike. We sold two of the 2030 19. I'm sorry, 9200 strike. That's where we're at. That's what was screwing me up. There we go. 19,200 strike. We sold the 19,230 strikes. We sold two of them. We skipped the 260 and we bought the 19,290 strike. Right now, this is trading for next to nothing. So the market moved down. We did this for a 135 credit, and we can close it out. It looks right now for a nickel. Now, there's no reason in the NDX to actually have to close out this trade. If we did get a market move, it would be over 200 points. So you're talking about a couple of percentage point move to the upside. And it's highly unlikely. But the fact that we're at noon on Friday, these expire at the close today, and that they're cash settled. If you get exercised in the NDX, all that happens is they look at the value of the index and they look at your strike price, and they either deposit cash or they don't deposit cash. So in particular, if I'm trading index options like the NDX, like the SPX, I don't mind allowing them to go to expiration and just allowing cash to come in your account versus trying to buy and sell the stock and dealing with all the math and all the paperwork that's behind it. I don't mind that on a stock situation like NVIDIA. It's okay if you're going to get exercised and assigned and you ride it all the way to expiration. It really just becomes an accounting nightmare more than anything. And it's all right to ride that position, even though it might be a large assignment, but your broker might not be okay with it. And that's one of the issues with most brokerage firms is if they're looking at a large assignment in your account, you can't trust the brokerage firm to manage the position as well as you would. It's just that straightforward. And so in the index options, it's not even a thought because cash just changes hands. When you're looking at large stock positions like in NVIDIA, it's a different scenario. Alerts are going to go off. There's going to be a large purchase of stock, and then there's also going to be an instantaneous sale of the stock. And if you don't have the cash in the account, they might just close it for you. And whenever a brokerage firm is closing out any positions, they have a tendency to just do it at market. So only because they have a lot of positions that they have to manage by the end of the day. So it's always good, I think, in underlyings where you have an expensive underlying, like Nvidia is right now. It's going to be a lot less expensive on June 10th. But when you have those underlying stocks, it's, to me, I'd rather manage the position than worry about the fact that as expiration approaches, what a broker might do with that position. It's very straightforward. Okay, NASDAQ index, cash settled, good. NVIDIA, underlying, expensive, not good, to sum up that whole scenario there. And I apologize for not being able to read my own writing, but here's where we're at on this trade. So 5 cents, I would let it ride. If you did get the market to move back up towards there's a very low probability of it happening. There's no reason to actually try to even pay the 5 cents on this because we already have the hedge on our trade, right? So if we look at this in the what if calculator, and I hope I don't freeze up my computer. Good. So in this scenario, if we look at the what if calculator, what is going to happen is the market is here. If it did come up towards this level, if it got all the way up to our underlying strike, this line is going to morph into the profit and loss graph at expiration here. So no reason at all to close it out, because if it hits that short strike, it would be a home run. You have a hedge in. Usually if you're doing a short spread, and that's how we always bill our skip strike butterflies. If you're doing a short spread and it gets down to a nickel, you close it out. You just don't want that. Even minimal risk, it's not worth it. But in a skip strike butterfly, you actually would like this market to start moving up, and you would actually benefit from that scenario, which if we were just short the spread, that would not happen. Now, I want to go back and I want to talk a little bit about GameStop because it's all over the financial news. Who knows where the stock is at, right? Because they've already halted it about 4 or 5 times today. GameStop came out and announced earnings to get ahead of the big event that's going to be happening at noon today. So they decided, I think more so from a regulatory perspective, they added a whole bunch of stock that they want to sell. They've already sold a lot based off of the rally, and they've also announced that they're going to be selling more. And I think that, I guess it's a real tough decision. Do you want, when you know that you have one person manipulating the stock so much, do you want to get ahead of the event, or do you want to ride it through? And so they made the choice that they're just going to announce earnings, and the earnings aren't good. Revenues aren't solid. But the biggest announcement is that they're adding millions of shares of stock that they are going to sell. And what happens when this stock gets so high in implied volatility? You look at the historic or the implied volatilities and the historical implied volatilities, right? You have an implied volatility of 1,392. The actual volatility, and this is on the front month, and this is because everything that's going on. And the actual volatility is 376, which is absolutely insane. But you throw in all the news and you get just ridiculous implied volatility numbers. So first of all, models don't matter. The models don't account for any of this. Excuse me. The skewing in implied volatility is going to be massive. And if you just look at even trying to buy way out of the money puts, and if you are correct on your forecast, it's hard to sometimes even make money because you're paying so much implied volatility on the way out of the money option contracts that you're trading volatility on these really high implied volatility options as much as you're trading the stock price. So if I look at the June 21st expiration, this is after, 14 days away, which is an eternity in GameStop. And you start looking at the put side of things. Here's the implied volatility. They're saying 400% on the 36 strike option contract. And then now, if you actually go to the downside here, all the way down, you have implied volatilities at 300%, all the way down on the 22 strike option. I mean, if you go all the way down to the 18 strike option, you're still paying 69 cents for that option contract. The markets are actually fairly liquid, but you're still paying on the 17 strike, you're paying a 7 cents difference in that strike. And you're seeing the same type of skew when you go to the opposite direction. And you look on the call side of things, you also have a situation where implied volatilities, as we go up to the upside, it's insane. So now we start at an implied volatility here of 417 on the most at the money option contract, 403 right in that range. And as you go up, you see higher and higher implied volatilities as we go up in price. We go all the way out to, oh my gosh, we're looking at going out to the last option that's available, which is the 120 strike. And you're still seeing implied volatilities of 500%, 395 by 540, strike price is 120. So let's see what we have to, if we were going to do a long call spread. So you would be buying on this scenario, you'd be buying the 725. Let's say we just do something that's obviously within the range. We'll start by buying an at the money option contract with 21 days remaining, trading at a 41% implied volatility. So we buy the 725 strike option contract and we sell the 58 strike or the 57 strike option contract. On this side of the coin, we are taking advantage of the fact that you can buy that one option contract and sell that one option contract for a net debit of $1, and you have 58 cents. We'll call it 50 cents. Let's call it 50 cents, even though it's moving all the way around, just to make the math simple. And you have a 50-cent net debit to the account, but with the volatility skew, because it's so skewed to the upside, you have a $9.50 profit potential if the market does go up. So on the call side of things, if you are buying calls, going out of the money doesn't necessarily make them cheaper, because implied volatility, like the difference between the 80, I just find this amazing. The 80 strike call is trading for just looking at the ask, $6.30. And the 115 strike call is trading for $4.85. So my question to you would be, why would you ever buy this option contract? Right? You get, and something that's why would I ever go further out of the money than I needed to on this GameStop position when you give up so little relative to the amount of points on that trade? So if I'm buying the 80, I guess I got to sell here, but $6.30, and I go up to the 110, there's only a couple of bucks, and you're talking about 30 points difference. So buying out of the money call options on GameStop is you're trading so many other things than just the stock price. Now, that The reason why they're selling for that is that GameStop could triple overnight. Like there is a probability of that happening, and that's going to cause that scenario. So let's go all the way down. And if you're going to do this, the moral to the story is you have to spread these positions. There's no way that you want to trade this outright. So let's look at a real. Let's go all the way down to the at the money strike, and we're gonna. Golly, look, there's just they're all trading for the same price. It's almost insane. So let's buy the 40 and let's sell the 50. Okay. So now you're talking about $1.65 for 10 point wide. That's not bad. That's an at the money option contract. We're not even at really at the money. We're at 36. Let's make it at the money. Let's literally buy the at the money contract. And then let's sell the 40. Okay. So if I were to trade this because of the skew and you want to get bullish, you want to do a shorter term option contract, might even look at the 7-day contract, but we're in the 14-day contract. We're buying the 36, we're selling the 40, we're paying $1 for 83 cents for that trade, and we got $9 worth of upside. Why is that? You're paying 410% implied volatility, and you're selling a 426% implied volatility. All right, now let's go to the other side and let's try to put a spread on the put side of things. Because if you buy a put, you're paying this astronomical volatility, but the market is leaning that way. So I would say the marketplace feels that there's potential for the upside, but on the downside, the skew makes it harder to put on a long call spread. So the marketplace is more nervous about that put spread on the downside. I guess I'm struggling with how to say that, but the market, let's say, so it's at 36. Let's buy this $11 option contract and let's go down and sell the 30 strike option contract. So we bought that one, we sold that one. Okay, so there you have a scenario where you're buying the at the money option. So the exact opposite of what's going on the call side. You're buying the 36 strike option contract and you're paying 400% implied volatility. And then you're selling the 30 strike contract and you're receiving a 365% implied volatility. The price of that spread is $4. We'll call it $4.50. Make the math simple. And so now you have a 6-point wide spread and you have to pay $4.50 for it. So you only have $1.50 of upside on that trade. Let's make it 10 points wide. So let's go down and compare apples to apples. So we get rid of this trade and you go down to the 26 strike. And we're going to sell that option contract. So now we'll call it $7. Make the math simple. We're paying $7 if we could get it off for $7. And I do think you could trade the midpoints on these. There's so much volatility and open interest and just volume in the options contracts that I do think it's feasible to be able to buy this at the midpoint. But here you're paying $7 for it. And you have a 10-point wide trade. So apples to apples, you flip that upside down and you do the call, you're paying it less than $1 on a 10-point wide trade. You're doing the put spread, you're paying $7 on a 10-point wide trade. So, put up the mind-blowing emoji right now. Very hard to get short the stock without speculating on buying way out of the money option contracts, which are very expensive. Even if you get down to the 22 strike on a percentage basis, that's insane. If you even cut the stock in half and you go all the way down to a 15 strike option contract, you're talking about still paying 18 cents for that on a 50% move to the downside. crazy. So I guess the moral to the story would be based off of way the volatility is. If you speculate on way out of the money option contracts, you don't want to spend a ton of money. Obviously, you're speculating; it's 100% gamble. And if you're buying out of the money puts, you have the potential of the skew helping you. So, like if I bought the 19 strike and the stock got cut in half over the next 14 days, which obviously the marketplace is pricing at a fairly decent probability of that happening. If that did happen, then the skew would help you because you'd be buying a 286 implied volatility, and the at the money implied volatility going all the way back is 414. So buying way out of the money option contracts on the put side, implied volatility could help you if the skews stay in place. If you go back to the call side, you definitely don't want to buy out of the money calls. You would definitely want to do call spreads if you're going to trade this underlying. The stock can get halted. It could get halted going into the close. There's even a high probability that if the event does happen at noon and the stocks starts trading even more volatile, that you could go into the close and the stock could be halted overnight, meaning you could not get out of your option positions. So that's another risk to throw into the trade. This is just a real interesting underlying the trade. Realize you're trading volatility, you're trading market conditions, you're trading so many different things if you choose to trade options in GameStop. And I guess that'll be it. Do we have any questions about these positions or anything? Please put them in the chat box right now. I apologize for having a little bit of internet issues, and also that I didn't set up my trade right to start with. So with that said, I think we're going to leave it there. Going to be watching what happens with GameStop. It's more of I do not have a position on the underlying stock. I don't want to trade it because there's so many external factors that are in on that trade. I'd much rather trade Nvidia going into their earnings report or going into their 10-for-1 stock split. What am I talking about? Going into their 10-for-1 stock split, then trying to mess with all the implied volatility and all the information that's going on with GameStop. Thanks for stopping in. We will be back Monday, and I'll be done traveling. I'll be back in my home office on Monday for the next edition of Options Guide TV. Please follow me on Twitter. My handle is @BrianOverby. We stream live on x.com for every event. Also check out the Tradier Hub. A lot of great speakers in there. You want to put a sign on in. It's all put together for you in a nice little website that will allow you to watch all the archives from all the great speakers that we have inside the hub. Thanks for stopping in, and we'll see you Monday at 11 a.m. Eastern Time.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.